Good morning. Let's get started. One comment about figure 15. Prices of existing single-family houses, 1980 to 2010. If you look at this graph, you might say to yourself, oh my gosh, we have a long way to go, because house prices today are still significantly above where they were 15 years ago. But remember, these prices are in dollar or nominal terms. There is no adjustment for inflation. So even if there was just 2% inflation per year over a period of $15, that would raise prices by 30 or 40%. So if you adjust for inflation, you find that house prices now are coming much closer to where they were before the beginning of the bubble. The house price collapse and the house price collapse had some significant consequences. One consequence is that many people who had felt rich because their home values had gone up and they had a lot of equity suddenly found themselves underwater, which means that the amount of money they owed on their mortgages was greater than the value of their homes. This is an upside down situation where the borrowers, in fact, had negative equity in the home. In figure 16, you can see that starting in 2007, the number of mortgages that were in negative equity grew very sharply. Currently, about 12 or 13 million mortgages out of a total of about 55 million or so in the United States. Roughly 20 to 25% of all mortgages are currently underwater. At the same time, given the fact that a lot of people borrowed more than they could afford, the decline in house prices also led to a big increase in mortgage delinquencies, people not paying on time, and ultimately the bank taking over the property, that is called a foreclosure, and then reselling the property to somebody else. Mortgage delinquencies are graphed in figure 17, and you can see that in 2009, there were more than 5 million mortgages in delinquency, which is almost 10% of all mortgages. That is a very, very high rate of delinquencies. We just looked at the effects of the house price bust on borrowers and homeowners, and those are quite serious. But there is another side to this, which is the effect on lenders, which approximately 10% of mortgages in delinquency, with approximately 10% of mortgages in delinquency, banks and other holders of mortgage-related securities suffered sizable losses, and that proved to be an important trigger of the crisis. There is an interesting question here. In 1999, 2000, and 2001, we had a big increase in stock prices, including but not confined to dot-com or tech bubble prices. Those prices fell very sharply in 2000 and 2001, and wealth, a lot of paper wealth was destroyed. In fact, the amount of paper wealth destroyed by the decline in dot-com and other stock prices was not radically different from the amount of wealth destroyed by the bursting of the housing bubble. And yet, the dot-com bust led only to a mild recession. The 2001 recession lasted from March to November 2001. It was only an 8-month recession. Unemployment rose, but not nearly so dramatically as in the 1980s or more recently. And so here we had a big boom and bust in stock prices, but without causing too much serious or lasting damage to the financial system or the economy. In the recent case, damage. In the recent case, we had a housing boom and bust. If we were looking back at 2001, we would think that would cause a slowdown in the economy, but probably it would not be very serious. That was one of the views we were discussing in the Fed in 2006 as we saw house prices decline. Yet the decline of house prices had a much bigger impact on the financial system and the economy than the decline of stock prices did. To understand that, it is important to make a distinction between triggers and vulnerabilities. In the recent case, we had a housing boom and bust. If we were looking back at 2001, we would think that would cause a slowdown in the economy, but probably it would not be very serious. That was one of the views we were discussing in the Fed in 2006 as we saw house prices decline. Yet the decline of house prices had a very bigger impact on the financial system and the economy than the decline of stock prices did. To understand that, it is important to make a distinction between triggers and vulnerabilities. The decline in house prices and the mortgage losses were a trigger. They were a match thrown on kindling. There would not have been a conflagration if there had not been a lot of dry tinder around. In There would not have been a conflagration. There would not have been a conflagration if there had not been a lot of dry tinder around. In this case, there were vulnerabilities in the economy and in the financial system that the housing bust, in some sense, set afire. In other words, there were weaknesses in the financial system that transformed what might otherwise have been a modest recession into a much more severe crisis. What were those vulnerabilities? What was it about the financial system of the United States and of other countries, as well as that transformed the housing boom and bust into a much more serious crisis? There were vulnerabilities both in the private sector of our financial system and also in the public sector. In the private sector, many borrowers and lenders took on too much debt with too much leverage, and one reason they did that may have been the Great Moderation. With 20 years of relatively calm economic and financial conditions, people became more confident, willing to take on more debt. The problem with taking on too much debt is that if you do not have much margin, if the value of your asset goes down, then pretty soon you will find that you have an asset that is worth less than the amount of money you borrowed. The second very important problem was that during this time, financial transactions were becoming more and more complex, but the ability of banks and other financial institutions to monitor and measure and manage those risks was not keeping up. That is, their IT systems and the resources they devoted to risk management were insufficient for them to understand fully what risks they were actually taking and how big the risks were. So, if in 2006 you asked a bank about the effect if house prices fell 20%, it probably would have greatly underestimated the impact on its balance sheet because it did not have the capacity to measure accurately or completely the risk that it was facing. A third problem is that financial firms in a variety of contexts relied very heavily on short term funding, such as commercial paper, which can have a duration as short as 1 day, and most of it is less than 90 days. So, like the bank in the 19th century, that were relying on deposits and making loans on the liability side their balance sheet, they had a very short term liquid form of liability which was subject to runs in the same way that deposits were subject to runs in the 19th century. Final private sector vulnerability was the use of exotic financial instruments, complex derivatives, and so on. An example of this was the credit default swaps employed by the AIG Financial Product Corporation. AIG used CDS essentially to sell insurance to investors on the complex financial instruments that the investors held. So basically, AIG was promising that if the investor lost any money on collateralized debt obligation or whatever, AIG would make good. As long as the economy and the financial system were doing well, then they were just collecting the premiums on this insurance essentially, and there was no problem. But once things went bad, their being on one side of all these bets meant that they were exposed to enormous losses, which had, as we will see, very serious consequences. So, those are some of the problems that occurred in the private sector. There were serious problems in the public sector as well. First, the financial regulatory structure was basically the same structure that had been created in the 1930s during the Depression, and in particular, it did not keep up with changes in the structure of the financial system. One aspect of that was that there were many important financial firms that did not really had any serious comprehensive supervision by any financial regulator. An example was AIG, which was an insurance company. The insurance regulators looked primarily at the insurance products AIG sold. The Office of Thrift Supervision looked primarily at the small banks that AIG owned, but nobody was really looking carefully at this CDS problem that I was just describing. Another category of firms that did not have much oversight was investment banks, such as Lehman Brothers and Bear Stearns and Merrill Lynch. There was no statutory oversight of those firms. They had a voluntary agreement with SEC for oversight, but there really was not comprehensive oversight of those firms. Another group of firms was the government-sponsored enterprises, GSEs, Fannie Mae and Freddie Mac, which did have a regulator, but for reasons I will explain, the regulation was very inadequate. The regulatory structure had lots of holes in it, and there were many firms that proved important during the crisis that did not have good oversight. Even where the law provided for regulation and supervision, it often was not done as well as it should have done. Although this was true across the whole range of agencies and parts of the government, since I am the Fed chairman, let me talk about the Fed. The Fed made mistakes in supervision and regulation. I would point out two. One would be in its supervision of banks and bank holding companies. It did not press hard enough on this issue of measuring risks. I mentioned earlier that a lot of banks simply did not have the capacity to thoroughly understand the risks they were taking. The supervisor should have pressed them harder to develop that capacity, and if they did not develop that capacity, should have restricted their ability to take risky positions. The Fed and other bank supervisors did not press hard enough on this, and that turned out to be a serious problem. Second area where the Fed per- performed poorly was in consumer protection. The Fed had authority to provide some protections to mortgage borrowers, and if used effectively, would have reduced at least some of the bad lending that occurred during the latter part of the housing bubble. But for a variety of reasons, that was not done to the extent it should have been. In 2007, when I became chairman, we did not we did undertake some of these protections, but it was too late to avoid the crisis. So where there were authorities and powers, they were not always effectively used, and that led to some weaknesses. All right.